I am a firm believer of having strong DSCR, which creates cash flow. And I think eventually the chickens come home to roost if you're not cautious. Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hey, welcome back to the show. I'm your host, Todd Dexheimer, and I'm going to talk a little bit about a few things today. First of all, to talk about education. I'm going to talk about LP lessons. I had a conversation with an investor who's in over 40 LPs, LP deals, syndications. And I've also talked with a lot of other LPs recently and just kind of lessons they've learned. And there's definitely plenty more lessons to be learned out there. There's a lot of other LPs I need to talk to, but I've learned quite a bit of talking through these LPs and what to look for, what not to do, what to do. And first of all, I'm an LP on deals, and I'll probably continue to become more and more of an LP, but I have my own GP deals. And as a GP, I want to make sure that I'm doing my best to protect my LP investors. Of course, there's always risk. I understand that. And hopefully my LPs understand that there's always risk, but the more that I can do to mitigate those risks, the better everybody is, right? And then the last thing I want to talk about is equity versus cash flow. So let's start off with just education. And I've been thinking about it because I read a lot of books. I listen to a lot of podcasts. And I was talking with somebody who was just wanting to get into multifamily, and I was talking about the books that they've read and haven't read. And I was just asking them about some of these books, and they want to become a multifamily investor, yet almost all the books they read were all about mindset. And that is cool. It's very good to be learning about mindset, but they hadn't really gotten to the niche. And so when I'm thinking about education, you need to really focus on the niche that you're wanting to get into. And that's reading the books, listening to the podcasts, going to conferences, going to meetups that are literally specifically talking about the niche that you're wanting to be in. And then, looking at some of the major web pages out there that are dealing with your specific niche. So I am a subscriber to the CRE Daily, Commercial Real Estate Daily, right? I get all their newsletters. I read them all. Props to them. They do a great job. TREP is another one, does a great job. They get a lot of information out there. I listen to TREP podcasts. I listen to many other podcasts, the Rent Roll. I'm connected on LinkedIn to a lot of people that put out a lot of good information, Jay Parsons and so on, that put out a lot of good information about multifamily specifically, but about real estate, about commercial real estate. And so those are the things you want to be doing, is always learning, always growing. If you're not specifically learning about your niche, I think that's a huge mistake. Mindset is for sure one of the things that you need to be focused on as well. You need to have the correct mindset as you're doing this business. Otherwise, you're going to struggle. You're not going to be successful. So being willing to take the risks when it makes sense to take risks, but it doesn't make any sense to take risks when you're not educated in that specific niche, and very, very well educated in that specific niche. Surrounding yourself with the people that are actually doing it today, getting a mentor, whether you pay them or whether they're you work for them, or whether they're just doing it out of the goodness of their heart. It doesn't matter, but getting people on your side is huge. Getting mentors is huge. And then learning about leadership. I think that's really important. Learning about business leadership, learning how to run a business is super important to be successful in real estate investing. Now, the leadership part may or may not really matter to you if you are more of a passive role. Then the first two are really important, right? Learning that niche, learning the mindset, and then passive role, you definitely don't need the leadership skills. But if you're active like me, you definitely need leadership skills. You need to learn how to lead teams, because that is a huge part of it. A lot of people think that just buying the piece of real estate is important. It's valuable. Certainly, it's true. You buy right, and everything else is going to do pretty well. But you can also screw things up by not having proper leadership, not understanding the business well enough, and you can make a good deal go bad pretty quickly. I feel like it's way different than maybe investing in like a single family home, but even that, you can make a good deal go poorly fairly quickly. All right, so that's it for education. Obviously, it's huge. I talk about it a lot on the show, but just something that uh, I just was irritating me when I see some people, or one person, I should say, that was not learning about the niche because they didn't think that was that important. I think it's super important, and I think it's always important to keep on learning. Like, I'm always learning. Now, I'm not reading a book that somebody wrote about the basics of multifamily, but I am always learning, always trying to learn through, what I'm reading on LinkedIn, what I'm reading on a lot of these online web pages. I'm going to the Minnesota Real Estate Journal. I'll be speaking at it, but I'm going to it and I'm going to be learning there. I'm always speaking with property owners. I met with a property owner the other day, and we just compared notes, and you learn things from that. You always got to soak it in. Don't just assume you're the smartest person in the room. Assume that, and you end up becoming the dumbest person in the room. All right, so let's talk about LP lessons. So I talked with an investor that's invested in a lot of deals, and they've got a lot of deals they invested in that have gone south. And these deals range from what this person would call Ponzi schemes to just poor investments. And one of the things that is a common theme among a lot of LPs that I'm seeing on deals that go bad, including this LP, deals that go bad is floating rate debt. So what a lot of people did is, first of all, they bought at the top of the market. That's really tough because we don't know when that's going to be, but they bought at the top of the market, and they bought in areas that, you know, had a ton of new construction. It had just, yeah, they got a lot of people moving into these markets, but there's a ton of new construction. And so absorption was going to be a problem. And they weren't looking at that. They were just hearing this story that, oh, so many people are moving in, but they weren't paying attention to how many units were being built. And I think a lot of people miss that. And those are statistics that you shouldn't really have to miss. Now, to be fair, uh, I shouldn't, I got to walk that back a little bit, because sometimes what'll happen is you'll buy a building and you might have a 5-year plan on that building. And if you have a 5-year plan on that building and the market shifts because a ton of new building starts to happen, let's say you buy the building and 3 years into it, 2 years into it, there's a ton of permits that happen, and buildings start to come online. You maybe couldn't have seen that happen. So I do need to walk back that statement. So that can sometimes happen. But what was happening a lot is that people were buying while they were already seeing that building happening, that intense amount of new units coming online. They're seeing that trend already happen, but yet they're buying even in spite of that. And not that that's a bad thing, because you can do fine with that if you actually underwrite for it, meaning my rents have to stagnate. I have to see some occupancy hits, right? I have to expect some concessions, those types of things. But they weren't doing that. They were saying, we're going to see 5% rent growth, we're going to see 95% collections, all that kind of stuff. So that was number one. Number two, and this is the biggest one, is that people were buying with bridge debt, floating rate. And this LP and many others that I talked to, that's the major rhyming thing that has gone wrong, is that bridge, floating rate, debt. And what happened is your rate is based on the SOFR plus a spread. Okay. Well, rates went from near zero to SOFR being, 5-ish. Well, that's a huge jump. So if you're paying near zero plus your spread, maybe your spread was a 3.5 or 4.5 even. It really depended. But spreads were anywhere between 3 and 4 typically. And you're paying, let's call it a 0.5% above that. So now your interest rate, if you were at 3, is 3.5. That's not bad. But if then rates SOFR goes up to 5, now you're at 8%. So you're literally going from 3.5%, right, to 8%, maybe big, maybe higher. Right? Yeah, at times it was higher. So your payment well more than doubles. So think about it. I buy this property and I am cash flowing, but I've got this floating rate debt on it. And maybe I even have a rate cap, so it doesn't play into, a factor right away. But eventually my rate goes up. And what plays into it is my rate goes up by more than double. And maybe I was paying out some distribution. So maybe I'm paying out like 4, 5% distributions. We're actually cash flowing, right? That looks good. But all of a sudden, this interest rate just skyrockets, eats all my cash flow. And now I'm losing money every single month. And if I'm losing money every single month, eventually what's going to happen? I'm going to have to ask investors for money, or I'm just going to have to give the property back to the bank. So what has then happened is, people have to buy rate caps to lock their rate, but the rate caps are only temporary. So these are temporary Band-Aid solutions. So the rate cap is going to cost a lot of money right now. You get a rate cap on call it a $10 million loan. It could be hundreds of thousands of dollars, right, for a couple of years. So that can cost a lot of money to get these rate caps and all that a rate cap is prepaying your interest rate. That's all it is. It's an insurance product to prepay your interest rate. A lot of people will say, well, we got bridge debt, but we locked in our interest rate. No, you didn't. You prepaid your interest. You're just trying to fool people. That's all. So that was a huge lesson. The other lesson is just not doing due diligence. Like, look, this person admitted it. He's like, yeah, it was my fault. Like, I didn't understand what types of loans were being put on it. I didn't understand truly the risks. I would ask, hey, what kind of black swan event happened? And LPs would give me an answer of, oh, it's cash flowing, blah, blah, blah. We're going to be fine. And just believe that. And then this person invested in some crypto stuff, invested in some ATM stuff, invested in some other things that, and I've talked with a lot of other LPs that have had these lessons, oil and gas, things like that they find out are pretty much Ponzi schemes. Whether they're Ponzi or not, they're basically Ponzi schemes. And so they're out all of their money because, again, they didn't do due diligence. They trusted somebody. I've talked to a lot of people that were investing with fund of funds managers. Now, you got to be very careful investing with funds of funds managers because sometimes those people don't know what they're truly doing. And so you are trusting these fund of funds managers because they're investing in the deal or they're raising money for the deal. And you like that person. You just think, oh, they've done their homework. You can't do that. You have to do your own due diligence, your own homework, and not trust these fund of funds managers, and not, quite frankly, don't even trust the lead sponsor. Now, I'm not saying these people are inherently bad. I have some funds of funds managers that I know that are fantastic people, and they do their job. They do their job. They do their due diligence on the lead GP and on the investment and all that kind of stuff, and they do a good job at it. And that's great. And they're kind of a second layer, right? But it still doesn't mean you should not do your due diligence. And that's what happened a lot. And sometimes it wasn't even a funds of funds manager. Sometimes it was just there's investment groups out there that review investments together. And they're like, oh yeah, if you're doing it, I'm doing it. And what'll happen sometimes is one person kind of looks at the deal and they're like, yeah, I'm going to do that one. And everybody's like, oh, okay. And so then that just spreads. And now nobody really looked at the deal. Everybody thinks everybody else looked at the deal, but nobody truly looked at it. Nobody truly did their homework on the sponsor. Nobody truly did their homework on the market. Nobody truly did their homework on the business plan. None of that stuff. Just because one person said they're doing it, then another person said they're doing it, then all of a sudden everybody's doing this. And of course, everybody must have done their homework, but no, nobody did it. And so that happened quite a bit. People were just sloppy and investing quickly. One of the best things I think that has happened in this private equity space, in the syndication space, is that people have become a little bit more cautious. And so they take a little bit more time to make decisions. And it's okay because deals are taking longer to fill up. I think that's a great thing. What I think is really cool, in fact, is our investor group. We used to fill our deals up really quickly. I'm talking like less than 24 hours. And so you couldn't really think that hard about that deal. You just had to do it. Well, now our deals are still filling up, I would say, pretty quickly. But it's instead of 24 hours, it's a week or two for it to fill up. So you have some time to call me up, ask me questions. You have some time to really dive into the details, to look at the deal, to think about it, and to say, okay, is this the right deal for me? To talk through the deal with your other investment advisors or spouse, or again me, or whoever you're talking with. So I think that's super important. So jumping in too quickly is a big thing. Man, I've heard it so many times, just trusting and not verifying over and over and over again. All right. So last thing I want to talk about is equity versus cash flow. I saw this person who said that, look, cash flow is, you shouldn't be looking for cash flow. It just doesn't make sense. Build an equity portfolio, stabilize it, then start doing annual cash out refinances in order to create the cash flow. And while I kind of understand what they're talking about, that's super dangerous. And in my opinion, cash flow is king in any investment. This person was saying, well, unsophisticated investors are going for a cash flow. I think that's the stupidest thing I've ever heard of. I think sophisticated investors are going for cash flow. Unsophisticated investors are just going for appreciation. While I believe in both, I think that cash flow is the first step. Equity is the kind of frosting right on top of the cake, right? So we all want equity, and our goal is to build as much equity as possible. But here's the problem. What this person said, it's really expensive. You have to refinance every single year, or even if you do it every 3 or 4 years, that's expensive. You pay $1,000 in fees just to refinance. So it's expensive. Rates also can go up, as we saw. And so if you do it at the wrong period of time, you're spending a lot of money on interest rates. And so it may not make sense because you may not be able to make your mortgage payment. Well, that doesn't do anybody any good. Values can also go down. So just because you think you've got a ton of equity today doesn't mean you always have a ton of equity. So you've got to be careful with it. You've got to make sure you're not over leveraging by just continuing to refinance and think that that's what pays the bills, right? So we've seen values in commercial real estate go down right now 25%. We saw it not that long ago, a decade and a half ago. Values go down well over 25%. Many cases, many areas, 40, 50, 60%. And so we know that values can go down. We know that interest rates can go up. We know it costs a lot of money to refinance. And then, look, if you do it too much, there's little to no cash flow. I am a firm believer of having strong DSCR, which creates cash flow. And I think eventually the chickens come home to roost if you're not cautious. So for me, if you want to directly own real estate, and even quite frankly, if you're wanting to invest in syndications, buy in solid locations, purchase something that you can add value to. That's not a hard, and that part's not a hard investment rule. The location is, in my opinion, the something you could add value to, I'm okay with not, but it's great if you can. I think that adds the equity quickly to the deal, and it really just kind of boosts everything, boosts the cash flow, boosts the equity. It really makes that deal pop. Then put debt on it that's fixed. Remember, LP lessons, this floating rate, man, not a good thing. Take it from this LP investor that I talked to. Put fixed rate debt that provides you with a high DSCR. I'm talking like 1.5 or higher, especially if now, if you have a value add, it might start out lower, but if we're going to have a value add, you want it at least that 125 and then try to continue to grow that to 1.5 or greater. It's especially when we're talking like single families, duplexes, anything smaller. Like, to me, 1.5 is the bare minimum. It should be 1.75, 2. Like, I want a high DSCR. So this allows you to cash flow property, grow your equity, and then over the course of 2 to 10 years, depends on what happens with the market, depends on how much equity you created, you can strategically refinance or sell, exchange into something bigger. But how I built almost my entire portfolio when I first started is I would buy a building. It was foreclosed on, it was vacant. I would renovate it, get some tenants in there. And then, so now I created the cash flow, and then I would refinance into a really good fixed rate, and then watched as rates went down. Luckily, they went down for me, so it worked out really well. And 5 years, it wasn't a formula, but whatever, 3, 4, 5, 6 years, I would refinance if it made sense. And I kept on actually increasing my DSCR. So my DSCR on the first loan might have been 1.5, and then rates went down. And so now I'm able to actually even do a cash out refinance. We'll see what happens. Look, I mean, if you locked in at 7% today and rates go down and they're at 5%, boy, I mean, you can do a nice cash out refinance. You can strengthen your DSCR, and you're going to cash flow like crazy. And it's a great thing. So while equity is great, cash flow is the fundamental. Cash flow is the foundation. Equity is everything above that foundation. So build on a strong foundation, have good, strong, solid cash flow, and then let equity be the wealth builder. All right. That's all I got for today. You have a fantastic rest of the day. Make every day a Saturday. Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe, give us a thumbs up, go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.